So let's look at a Money Guy case study where we actually test the numbers using a real policy designed by a real insurance agent. So let's assume that you have Infinite Banking Isaac. And Infinite Banking Isaac is going to put $10,000 per year into a high dividend, whole life paying policy in order to carry out infinite banking. That's what Isaac's going to do. And so the dividend rate we're going to assume, which is the dividend rate as of right now in 2023, is 5.2%. And the non-guaranteed values assume that this rate stays constant for the entire life of the policy. What we're saying is we're going to lock in 5.2%, and we're going to assume it does not go down even if interest rates fall. So we're trying to stack the deck in favor of the illustration. Make sense? All right. We're also going to say that by the time, since we're doing paid up additions, since we're buying more insurance, at age 65, the non-guaranteed cash value, this is from the illustration that an insurance agent actually provided for us, the non-guaranteed cash value will have grown to $532,000. The non-guaranteed death benefit at that time is $897,000 at age 65. Now, this is an important thing to mention. When Isaac first started buying this policy, remember the whole idea is I'm going to dump a bunch of cash in, I'm going to buy paid up additions throughout the life of the policy. When he first took the policy out at the very beginning at 36,
age 36,
it was only a death benefit of $196,000.
Okay.
So that $196,000 death benefit over the next 30 years grew to be $896, but it didn't start at $896 because I think that is something worth noting. His cash value by perpetrating the strategy went all the way up to $532,000. So the question is, what does his investment return look like?
Now, before you give us the aha moment, I want to make sure I put it out there. First of all, thank you to the life insurance agent that was willing to come forward and just share it with us. I mean, because it's hard to get information on these type of products. So to actually have somebody come and say, hey, I use these. I think I'd love to get your take on it and share it. We're not doing this just to straight up just rip it up. Mm-hmm. We tried to give it the best scenarios we could. I mean, let's face it, timing wise, interest rates are at the highs they've been in the last 30, 40 years. That's probably a great time to lock in guaranteed type returns. Sure. We tried to give it some benefits of the doubt on that. And we didn't pull any money out. So with all of that, and then thanking the insurance agent, what's the rest of the story?
So here's the rest of the story. Over this 30-year time horizon, if you look at the $300,000 that was paid into the policy and the guaranteed cash value of $532,000 and the guaranteed death benefit of $896,000, the actual rate of return that was received in this policy, 3.62%. Over this 30-year period. When you think about the return on capital that was deployed into this policy, 3.62% does not get me super, super excited. And this assumes you didn't actually use it for the number one benefit that's touted from it, which is borrowing money from the policy through time.
And now, I know earlier you showed it on the assumptions page. This thing was paying over 5%. Mm-hmm. So for it to have returned 3.6, is that because it's back to what you said? You're only earning off the cash value, yep. And then that's net of fees and all the other things that are coming through.
There are fees coming through, and then a portion of that every single year, every single month is paying for the insurance. So it's not like you had all $10,000 working for you or all $10,000 having that 5.2% dividend rate applied to it. Now, again, these are not numbers that we did. This is from an actual insurance policy. We just calculated the rate of return, 3.6% over the 30 years. So Then the immediate question we have is, might there be a better alternative? Might there be something that looks different? If we were not going to do infinite banking, what would the Money Guy team do? How would we approach this? Well, we said, all right, let's look at Manny the Mutant. And you guys have seen Manny the Mutant a few times on this show before. And let's assume that Manny wants the exact same protection as Isaac, but he's also going to just invest the remainder in the stock market, right? So Manny, a 36-year-old male in excellent health, goes out and gets $1 million 30-year term policy, right? And I say $1 million because we know at the end of Isaac's policy, it was worth about $896. We kind of rounded up. 30-year policy, $1 million of coverage. It's going to cost him $788 per year to have that term policy in place.
Now, right out of the gate, he's going to have a lot more life insurance protection
for the whole time
than the whole life. So even though he's only paying $787, versus the whole life is paying $10,000, he's going to have almost 5 times the coverage?
That's exactly right. Instead of 196, he's going to start with $1 million. And then we're going to say, okay, well, we're going to have the same cash outflow as Isaac. So he's going to invest the remaining $9,212 into the market and earning 8%. We're just going to use an 8% rate of return for a 36-year-old investing for the next 30 years. How does this play out? Well, there would still have been a $300,000 capital outflow by Manny, but at an 8% rate of return on the dollars that were not buying the life insurance, right? That were not buying that, the $9,200 that was going into the market would be worth almost $1.2 million. And from 36 all the way to 65, because remember, it's a 30-year policy, there would still be a $1 million death benefit in place for Manny the Mutant. So when you look at these two stacked up next to each other, you have the infinite banking Isaac, who has $532,000 of capital available. But then you have Manny the Mutant, that has $1.2 million of capital available. Isaac has almost $900,000 of life insurance coverage at the end of the policy. Manny had $1 million for the life of the policy. Isaac's money that he was investing, if you look at it, was making 3.6% in the single product he was investing in. Manny, the money that he was putting to work for himself, was making 8% over the long term.
Now, we need to be completely transparent, though. Age 66, the life insurance gone with this term.
It does.
The cost of insurance is going to be so expensive
exactly
now because the underwriting is going to have to be done again. You would probably just not be able to afford the life insurance. So that $1 million will disappear.
Yep.
But I mean, it was one of those things when I saw this case study and I was looking, I was like, but that's okay, because realize, as we showed in the best case scenario for the infinite banking, the death benefit would be $896 and the cash value would be $532. Mm-hmm. You don't get to keep both.
No,
you only get either or. So the only way you get the $896 is if you die.
That's it.
Versus, at least with the investing, buy term, invest the difference, you at least now get to have the assets and then use the assets, and then your heirs get the assets later. Yep. You don't have to die to get the higher number.
Yep.
Am I getting this right?
No, you're saying exactly right.